Yo, 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 what's goody?
Oh, we're live?
Yeah, allegedly.
Allegedly. What's up?
How are you? What's been going on in your hood?
Oh my gosh.
Right?
I'm coming off a marathon weekend where I was kicking it so much I had to schedule naps in between because I'm a millennial. I'm an older millennial,
So I guess that makes me the younger millennial and I have no excuses then. So
no, I was this was when I say a marathon, I mean birthday parties, like Netflix tapings for comedian Nate Jackson. For he had a Netflix special and they were filming it in Seattle, so that was pretty dope. I went to 2 shows, and yeah, I had to take naps to be prepared. So, I'm coming off of a big fun weekend of kicking it, celebrating birthdays in January. All of that. So I'm good. How are you?
I'm doing well. It's like we're 14 days into 2025. And
Crazy. It feels like 20 years at this rate.
I mean, look, it's a lot going on. But before we get started, I want to definitely send a huge thoughts, prayers, and also ask for support for those who are living in LA. Definitely devastated by wildfires, or I don't know what the genesis of the fires are. It doesn't matter. What matters right now is just making sure that people are safely in places in which that they can breathe. They can also have adequate lodgings, and if you can support, please feel free to support. I posted something on my social, and I think Jolene, you posted something on your social as well. So be sure to do that. Yeah. So our hearts are out with y'all, and also we're here.
Shout out to Altadena. Oh my gosh, the devastation of a historically Black neighborhood.
Indeed. And the goal is that essentially as it rebuilds, that essentially that we bring back its historical value as well. Don't let it die just because of the fact of the fire devastation. So, okay. Yeah. So if you can, go and support. All right. So what's up, everybody? I'm Mark Monroe, accompanied by my wonderful co-host, co-producer, co-creator, and all things galactic. Give it up for none other than the GCEO. It's
Jillian GC in the place to be. What does it, cousins? Yeah, it's Tuesday. A lot happened, Mark. You said what is it? You said the 14th day?
14 days in.
Yeah, so a lot's been happening all over. But we had the Friday's job report that came out.
We did have that.
And it was strong December job growth.
It was a little, it was coming in a little strong in the muscle. And I guess apparently the market's just like, wait, hold up.
Now, do you think the market overreacted?
I think that the market overreacted. I think that the market's been overreacting. I think that ultimately the market's been following along in the bond market. But before we get into the weeds of it, first things first, be sure to like, comment, and subscribe on watching this video. The reason why we're doing this week is because of the fact that we listened to what you guys have said. You gave us 500 likes, and ultimately here we are doing another show where we're providing you yet again more value. So yeah, I mean,
I think Mark, for this time though,
what's good
if we come back next week, because technically we go every other week.
Other week.
I'm back next week. It's really going to be based on the likes. So I think when I last checked, as of this morning, it was at 660 likes. So I say 750.
So 750 likes. And so, okay, so if we do that, I'll bring a guest on the show next week as we go into earnings week. That'll be a great kickoff.
Ooh, I know who you should bring.
Okay.
I'm not going to say that. I know who you should bring.
All right.
Especially when it comes to talking about earnings and excitement. So, yeah. But anyway, Mark, the jobs report was strong. So that's great.
Yes.
That's really great.
It was good. It was very good. We showed that there was some strong growth. I think that a lot of those numbers were also due to like the holiday numbers that we typically always see a spike in December jobs. I mean, naturally, because of the fact that people are working holidays, it's going to be interesting to see what that rollover is from December into January. So we'll have to wait for that one to come out. But we'll be getting some job numbers as we go towards the close of the month.
Well, that jobs report too was also based on like the household surveys.
Right.
But so we look at tech though, Mark, because Microsoft is laying
And
folks off,
Meta's
Facebook
laying off
or Meta,
5%.
yeah. Mm-hmm.
Yeah. I think there's other companies that are also going to follow suit as it pertains to layoff, and they're ruling it based upon, oh, how fitting. They're ruling these layoffs based upon poor performance. So poor performance
Right.
areas of the company. So which
Mm-hmm.
is letting you know that essentially a lot of these companies are starting to get a little bit more leaner. But at the same token, they're getting more and more efficient. The first one was the fact that we just had to reduce our headcount because of the fact that our CapEx spending is through the roof. Now CapEx spending is being reeled in again, except that you're looking in the lower efficient areas of the business. But the way that you're going to look at that is you're going to look at the low performing areas and say, okay, hey, how is it that we can improve the business so that way essentially it improves profit margins and also improves areas for growth. Or essentially it's like, okay, hey, we're gonna have to make some decisions even further. So I think that ultimately Microsoft and Meta are just the tip of the iceberg. I think that there's some other companies that are quietly doing it. But now we live in a day and age where like people just leak the information as it pertains to internal memos, whereas once upon a time you did that ultimately it was like the kiss of death to your career.
Now it's commonplace.
Now it's just a commonplace as it pertains to like, just part of the news cycle where everybody's getting that information, which, hey, I'm here for it. Democratize the information and the news. But yeah, so jobs report. Go ahead.
I was going to say the unemployment rate fell by 4.1%. So
yeah, so it fell to 4.1%. So we're still within that 4% to 4.4% range as it pertains to a gauge. I think if we go beyond that, then that, people will start to get spooked, and that will also like possibly trigger the Fed for sure. But as it stands right now, job market still seems very, very strong, and it's been going on strong for quite some time, even though that everybody thought that essentially that it would get worse as it pertains to unemployment rates. But I think, like I had said during the summit, shout outs to the Tech and Wealth Summit of 2024. So I had mentioned in that conversation that we would probably get to no higher than 4.4. I think that we had probably peaked at like maybe 4.3%, unless something else has changed in 2025. And again, I think that, ultimately we're seeing some signs as it pertains to some issues within the markets. For example, why would companies start to cut CapEx spending if we're not headed towards a recession, if things are not slowing down? So I think that we could be having a miniature recession, and I think that we will probably get that number sometime around around May of 2025. So mid-year, we'll probably get some information that we don't like to hear or that we didn't want to hear, unless things have changed. It does fall in line.
What you said last week, though, too, about like this whole mid-cycle growth. So
yeah, so when you find yourself in the midst of that, when you're in between cycles, things get pretty slow, and it ultimately causes things to recess. You're also seeing in some areas where you're seeing some stagflation, as well as in some areas you're seeing some deflation. I think that ultimately the other part that's going to cause a little bit of worry as it pertains to inflation, as it pertains to insurance companies, what they're going to end up and have to pay that bill, which would possibly trigger some things, because I don't know if they'll be fully solvent on that. So that's
they dropped so many people, Mark, before, like in September, I believe they started dropping insurance policies. Like
that is correct.
So for this.
So I think that honestly, I think that bill is just going to keep climbing. And, people are just looking at what the preliminary number is. I always say, okay, that's just a preliminary number. Okay. It probably may be a little bit worse, because of the fact is we have to think about it from another perspective of cost of materials and everything else that it costs to rebuild. And depending on where you are in the inflationary cycle, that can have impact on, say, for example, materials and labor. So something to just
think about, but honestly,
definitely keep in mind.
This is a time, well, it's long overdue, but we need to start looking back and really seeking out indigenous wisdom when it comes to certain landscapes, and in particular this California landscape, because this landscape has been this way, for a long time. And if the indigenous were able to manage it all that time, and now things are out of control, and these plants have really taken on certain qualities for survival that make them more prone to catch on fire.
Yep.
Then it seems like now it's time to return to indigenous knowledge and ways of knowing. But no one's talking about that. Like, that's not a conversation that
No.
is
I mean, in the
widespread.
midst of it, it's like in the midst of it, everybody's just more so thinking about it from a triage standpoint right now, where
Right.
they're thinking about like, okay, hey, what is it that we can solve today? Nobody really thinks about really like next week or tomorrow or, you know, a year from now. What they're thinking about is like, okay, hey, what issues can I solve today? Because that's the only thing that's only on my mindset right now, which is
Yeah.
fair. I mean, it's not a shade or a knock towards anybody, but it's just a way of thinking in the sense of, you know, I think that we will get there. Hopefully, I'm
I
hopeful.
hope so. The planet like really counts on
Listen,
that. But
yeah,
anyway.
yeah. So it could get very interesting as we move forward, but those are the things to definitely pay attention to as it pertains to like insurance companies as well as materials. What does that look like? So like lumber, you know, looking at companies like Weyerhaeuser, and then on top of that, looking at companies like, for example, Home Depot, because a lot of builders use places like Home Depot as it pertains to places in which that they get materials from. So it could get interesting as it pertains to what those, like if we see any type of inflationary pickups there on the retail side and also on the material side as well.
So that's
so
for
yeah. So speaking of which, like if we're sticking to the conversation, because I think that we got some other key economic indicators that I want to share with you, if that's okay.
Oh yeah.
Real quick.
Mm-hmm.
So of course we got consumer price index, which comes out on tomorrow, which is expected to show about 2.9% year over year inflation, up from 2.7% from November. I think that there's a lot of people in that camp. I think that it's kind of an interesting point here. Jolene, did you know that every single forecast from like financial institutions all have the same forecast as it pertains to core CPI?
Really?
They are all saying the same thing. They are all saying that core CPI will be at 3.3%.
Now that's interesting. I wonder if that is a report they ran using some AI and everyone's deciding like, hey, this is what it's going to be.
It could be interesting. It could be very, very interesting. So something to watch tomorrow, because ultimately, as you can see, we're seeing a lot of volatility within the market.
Okay.
And there's a lot of data points that are coming out. There's a lot of folks that are like in the part of like taking profits and everything else and trying to get a good gauge as it pertains to what the sentiment is, what the market dynamics are, and then on top of that, what the economics are, to kind of get together a full picture. And then on top of that, we got the other big thing, which is earnings, which I'll get into some of the companies in a little bit. It's just a one large concoction. And now it's like everybody's like passing around like, okay, hey, who's going to take the first sip?
Well, Mark, there was one thing from last week that we had to carry over to this week.
And that is
the corporate credit markets.
Okay, let's discuss it. So
that was key. We just didn't get to it though.
That is true. And apologies, y'all, that we couldn't get to it, but hey, that's the reason why we're here today. So
right.
So corporate credit. Let's make some notes. I have some notes here on my side here. Okay, so first things first, I do believe that corporate credit will be elevated in the first half of 2025. So that's going to stay high. I think what I have also because I jotted down some notes here. So the default rate for speculative grade, so U.S. publicly traded companies, so the speculative companies, is projected to rise about 3.1%. And so from 3.1% in September 2024 to by the end of Q2, we'll probably be at 3.4%.
Okay.
So just a little bit more risk appetite as it pertains to that. And then so let's get a little bit further into some of these risks, right? So commercial real estate, that's one of the main things that essentially that, like, for example, a lot of folks are getting these RTO mandates. where they're asking you to return to the office for 5 days out of the week versus like doing a hybrid scenario. Well, there's a reason there, because of the fact is that, you know, if X companies are in a building and the occupancy rate of the building is, let's say, at only 30%, well, then that's going to raise premiums as it pertains to cost. Or essentially that's going to bring down the cost as it pertains to rate for folks that are new companies looking to find office space. So I think that you have a lot of companies that are on the books as it pertains to their debts. And a part of that is, like, for example, their office costs. And so essentially to satisfy that office cost is to ultimately occupy it. And I think that that's the reason why you're seeing a lot of these RTO mandates.
That makes sense.
There's
Besides
a lot of folks that are reluctant, though. Yeah. There's a lot of folks that are reluctant to going back to the office, but I mean, that's a major part to it. So let's look at another area in which that we can see that there's some sector that, so real estate is one of those risks. Then we also have financials and energy. They may be the beneficiaries though, because of deregulation, one. And, you know, while tariffs and immigration policy could squeeze margins on some of those consumer and retail sectors, which that's something to put into, like, just put that down for, you know, possibly as another topic to discuss at a later time as it pertains to consumer and retail. But the thing is, there is, like, when we think about like the maturity, so a lot of like debts are on the book to mature in 2025. So a lot of people, a lot of companies' day of reckoning is coming as it pertains to that debt. So here's a cold stat line. Of the $94 billion of speculative grade debt maturing in 2025, right? 27% currently hold ratings of a CAA and lower, which is, that's like junk. That's like distressed. That's a distressed rating.
So how do you think that's going to impact the market overall?
It could have, if you, like I said, when you have those types of debts and ultimately you're reaching a maturity date where that debt has to be paid, you're going to be forced with one of the two things: either pay the debt or you're going to have to ultimately roll it over for something else. And depending on what the interest rate is,
I feel like that's going to impact smaller businesses more than larger corporate.
Here's the funny thing. I'm actually talking about this. The companies that I was telling you about, the 27%. Those are publicly traded companies.
So that's going to impact their overall.
So that's the reason why you look at it as it pertains to small and mid caps. The reason why essentially it plays a part in the portfolio, but it doesn't, and it never will be, you know, never a bride, always a bridesmaid. To put it into perspective. That's the reason why small and mid caps will never be that, because there's a lot of speculation there. And on top, it doesn't mean that they're not going to have a good year. It doesn't mean that they're not going to have a good run. But it's just the fact is that they're just not going to be the overall dominant player unless everybody just wants to take on that much amount of risk. And in order for that to happen, the cost of capital has to be ridiculously low. Exactly. So I think that what we're going to probably see is that companies are going to probably start rolling over that debt. And so we're going to probably see the debt servicing costs rise on that area, which could possibly hit some of their earnings. So you'll probably see some of that in the print for some of these companies. Now, of course, let's look at it from a global perspective, shall we? So let's look at S&P Global, because a lot of folks don't realize S&P Global is an actual, you know, that's an actual org company. So S&P Global ratings expect global credit conditions to remain generally supportive in 2025, with their credit cycle indicators signaling a potential credit recovery. So that's globally. Now, what's one of the major countries that ultimately is having a significant risk as it pertains to financial?
That has a risk? That's risky?
That's very risky right now.
I'm going to say us. China?
There's somebody's word. Yes. Think about it. Think about all the real estate that's significantly distressed that's in China.
Oh, yes.
Like all the debt that they're carrying, and that the government is ultimately trying to like literally, you know, it's like they're trying to keep the effects down. They keep giving it to treat the symptoms, but ultimately it's like the problem still exists. So and it's very persistent. Like real estate is one of those things where like companies can go through tough periods, right? They can go through tough earnings periods. They can go through tough moments. It could be consumer related. It could be based upon enterprise customers, where you're at in the market cycle and everything else. Real estate is one of those ones which is just supposed to be a stalwart, where it just like it doesn't quite move that heavy, but at the same token, it's also very supportive. That can also keep your portfolio very like, okay, at least I have some things when the market gets volatile. At least I know that I have some things that will ultimately be like a tree with deep roots that will just, hey, hold
So
me still.
We can't have a shaky, volatile market and then also
Real estate
shaky real estate.
Look at what happened within the financial crisis here in the US.
Right.
Markets were shaky. There was a lot of speculation within the market, but then the debt bomb came off as it pertains to the real estate market. And then that just like, it came through like a natural disaster, and just like, okay, like when you expect the things that are supposed to be, again, deeply rooted, and they're not as deeply rooted. And remember what we talked about last week, where I mentioned as it pertains to what's happening within China's economy, as it pertains to like, you know, people our age and younger. Mm-hmm. And let's just say the Gen Z population, we'll start with them. There and them not participating in the economy, and essentially like things like not happening.
Right.
That's a major risk. Like, you know, when you don't have people working and everything else, that takes you take major hits as it pertains to GDP. And when GDP takes a hit, like think about it, you got folks that can't afford to like live. And we see the same things here in the US. It's not just like China specific. You're seeing this across the entire board, where pretty soon you're going to probably have something that's going to have to break in order for that to happen. And it's like you're seeing a changing of the old guard, where you're seeing like folks that are baby boomers that are now starting to retire, and they're retiring now. But yet at the same token, it's like, okay, hey, the jobs in which that people are trying to move into, it's like they're not going to be paid the same.
Right.
So it's like we kind of like missed a few of those passing of the baton moments. And because of the fact that we miss those passing of the baton moments, it's going to greatly have impact as it pertains to the next generation. And hence the reason why I said, see, I'm connecting all the dots for everybody now. Remember that episode where I also did, we're cooked? Well, yes. Dots connecting. Like, hey, people are literally struggling to, one, enter into the market and also flourish within the market. The people that do have jobs, do they make enough? Real estate is expensive in the cities in which that you want to live or that you currently reside. So it's taking a significant portion. Like the way that it's supposed to go, I think, like, for example, for your living expenses, your housing should only cover, it should only cost about 30% of your living of what
That's
you make.
That's not the case.
That's not the case anymore.
It's like 50%.
There you go. And in so in sometimes higher than that. So it should be. So now what we're seeing is about 50 to roughly, in some cases, 70% on the high note. So then if you got 70% or 60% of your paycheck that's being gone, that's been taken from, say, for example, just your housing, it doesn't leave very much left. So which means that essentially that it becomes unaffordable.
This sounds like a recipe for disaster. It just sounds.
It does. And it's and like I said, we're seeing it across, like, look at most major metropolitan cities. They're all facing the same thing. And everybody knows that in order for things to like really start to take place, it makes sense the reason why RTO mandates are starting to happen. It makes sense the reason why they're starting to become more lax on the H-1B visa situation. It makes sense the reason why essentially that companies are also like, okay, hey, we're cutting our CapEx in low efficient areas of the business. So it's tough, but you know, buckle up.
Bleak.
Okay, so keep in mind, so keep in mind we got some other things like PPI that actually came through great today.
Yay!
It came in lower than expected. So yeah, I gave you something great. Great. What was supposed to be good news is like people are still pessimistic. Which is fair. I mean, in this typical arena, people are going to be very pessimistic, but I mean, 0.2% versus the 0.3, which was expected. So we'll give you a golf clap. Retail sales, it's coming. So we're going to see what those numbers look like. It's interesting though, because, especially like when you think about like things like the TikTok ban, people are thinking that, okay, that's going to affect companies like Shopify, and which it will have a small effect, but at the same token, will it have that grave of an effect? Which is really making people wonder, like, okay, hey, how will this significantly change, say, for example, Meta's revenue?
That's a good point, because Meta's lobbying hard. They've been lobbying hard for TikTok to get the boot here. Oh, just for the record, sorry, PPI, Producer Price Index, just in case someone didn't know.
It's like a wholesale. It's a wholesale data read.
Yeah. So I think
Costco numbers.
It's very interesting though, because you think about TikTok Shop,
Yep.
and you see them really taking market share from Amazon.
Yep.
And before it was like you could look on whatever TikTok Shop had, and then you could find it on Amazon and get it faster. But TikTok, well, until the 19th, I guess, now they have faster shipping as well.
Yeah.
So,
but that's thanks to Shopify though.
I'm saying, so it just seems, if we're talking about connecting dots, we see who really wants TikTok out of here. It's not about free speech. That's not it. It's all an economic ploy. Like, it's not.
You got to follow the money. Like, that's the thing.
Exactly.
Like you got to follow the money. Like, people don't get, like, you have to remember certain arenas play by different sports. In the public eye, yeah, okay, people fight over ideals and everything else. In the business world, it's dollars. Even in the political world, it's dollars. So if it's something that's that's affecting dollars, trust and believe,
that's why
it becomes an issue.
But see, that's why the argument should have been, and I'm talking about from the American citizen side of things.
Yeah.
Forget about free speech, because free speech isn't even about, if you really look at the Constitution, you'll be surprised about what free speech is really about. If you look at that plus case law, we don't have time to get into that now, but that was like the poor argument to make. It really should have been about these numbers and how it impacts small business owners in America. Yes. So, I mean, there's still time to call your senator, your representative or whatever, and say, hey, look, this is impacting me. So, vote this for the TikTok ban or whatever. But the argument is really in the money part.
Yeah. Yeah. Yeah.
Well, I'll just say that I have visited over there on Red Note. It's super peaceful.
Oh, word?
It's a different vibe over there. It's very peaceful.
Okay, I may have to give it a look.
Yeah, check it out. But anyway,
I'll just have to do it. I'll do it on maybe on the bat phone, so that way I can make sure that it's all clear.
Yeah, I risked it all.
Yeah,
ain't no telling. Because honestly, okay, so Mark, did you update? I'm sure you updated your phone.
Of course,
yeah.
Always.
Well,
I run developer editions on my phone.
I have to go on there. I'm still not done. I have to go through all my apps and turn off the Apple Intelligence. For all of it, Mark. It just automatically said, okay, well, we're going to use this app. We're going to learn from your usage of this app.
You think
that is a privacy violation?
Time out. You think that this started with Apple Intelligence? You don't think that they've been doing that before?
I'm sure they've been doing it before, but I mean, I was looking at my apps, and I went to settings, and I was just looking at something, and then I saw that Apple Intelligence now was following my usage of all these apps. I'm like, Apple, I did not say you could do that. Well, I just didn't appreciate it that way. I would have appreciated a text message, an email, a phone call, something.
Well, I hate to burst your bubble, but there is this company that literally learns from behavior, like app discovery, maximize your mobile apps monetization, drive marketing results with top performing, access the leading programmatic exchange, the whole nine,
I'm aware, but I'm just,
Like,
I got to ease into it. You know what I mean? It can't
I'm
just
just
be
saying.
right. Okay.
Look, a lot
Anyway,
of these companies,
I just,
have already been listening. I mean, they've
well, that's
always been
evident.
listening, and you know, that's all. Like, it's kind of like a conundrum because it's like, okay, on one side, we don't want the app, like you don't want it, but then at the same token, you do want it because then that's ultimately what makes the app better. Versus, like, that's how we got to like having apps that like made consistent updates to make things more efficient, so that way it also performance issues and stuff like that were not a thing anymore. Whereas once upon a time you would get an app update like every 6 months. Now you're getting an app update every like 2 weeks, 2 to 3 weeks, or every 4 weeks is essentially the cycle. And so, yeah, I mean, that's the thing. Okay. So let's get into something. I'm going to just talk about the Mag 7 real quick. Just really quickly, because I know that a lot of folks are wondering, and Mag 7 is one of the main things that literally, like, so far that has been pulling up the S&P 500, though that I believe that the bull market itself is broadening out. All right, so let's start off with Microsoft. So there's things in which that I want you guys to focus on. So this is my thing as it pertains to my notes of what you should focus on.
Okay.
So for Microsoft, we'll start off with Microsoft that reports on January 30th. The things that you're going to focus on is cloud computing growth and AI initiatives. So do the AI initiatives literally point towards its core business growth as well as revenue growth? That's going to be the number one question for a lot of companies that literally been tooting this whole AI. So pretty much that's going to be the thing. Does it equate to revenue? If it doesn't equate to revenue, then that's a problem. If it does equate to revenue, and we're starting to see areas as it pertains to growth markets within the AI space at these companies, okay, expect them. I think expect investors to respond positively.
I do want to say something, Mark, before you move on to the next company.
Go ahead.
For Microsoft, I was reading that remember last week we were talking about the business side, like business to business, and the enterprise model.
Yep.
Yeah. A lot of companies prefer Microsoft cloud services, Azure, over other
AWS.
ones. So yeah, so I think that's going to be good for Microsoft, and also keeping in mind that Microsoft was on the end of 2026 playlist. So if companies are already having Azure as a preference, and businesses are already moving more towards the enterprise model and kind of saying, okay, consumer now, y'all are second, it is going to be good for Microsoft and other businesses that follow that model.
Yeah. So the biggest thing is like advancements of AI and integration of AI. That's going to be the biggest thing. And I think that honestly, like, of course, AWS has its thing as it pertains to its neuron compiler. That's like AI that's built into the hardware, like a lot like NVIDIA, but except that it runs through the cloud service. So that way you don't have to run the deploying and everything else. It just does it on its own. Google getting there with its Gemini advanced models. But I mean, the fact that, Microsoft has been participant with like, OpenAI as well as with NVIDIA as a partner, I mean, I think it gives it a clear advantage for now. But those things can change. I mean, we've seen where AWS was the major leader as it pertains to market share. And then, of course, now we're seeing Microsoft really being one of those front runners, whereas once upon a time it was sitting in dead last. So it's funny how those things change. Like, it's funny how like 7 years can change everything. But
Well.
All right. So then let's take a look at Google. Key areas, of course, there is ad revenue, and of course, their AI developments and quantum. Here's the interesting thing, though, especially since we're looking at since their earnings is the 29th. Interesting thing is going to be to listen to on the call is what is it that, like, especially let's say if TikTok is now officially banned, right? Well, people would say that Meta is the front runner as it pertains to like, content, but who's not to say that YouTube doesn't get boosted on its YouTube Shorts and its YouTube platform? That could be a major competitor as it pertains to like, Instagram Reels and everything else. So So I would say like this allows Alphabet to step into the conversation and literally like, hey, it's a possibility.
What's the difference though between I guess as far as
What's the
audience
difference between
the
Meta
reels
and
and the
YouTube?
shorts? Well, just the reels and the shorts.
I
Like when
think
it comes
the
to the
one thing
text
is
side
with
of it.
well, I mean, encoding quality, how is it that they're
Mhm.
written as it pertains to their infrastructure?
Yeah, that's what I'm talking about.
Yeah, I mean, Meta sits within the Instagram or the Facebook ecosystem, so they put it across the ecosystem. Whereas with YouTube, it's really focused within the YouTube arena. But I think that will give them opportunities also for growth and to expand beyond, say, for example, YouTube. Sorry, so. So it'd be interesting to see exactly what that looks like, but it could possibly open up some growth drivers.
Do shorts
For
come up
Alphabet.
in search in Google
Yes, it
searches?
does. Yes, it does.
Okay, I haven't seen that yet.
In some cases, like it's still, I
Mhm.
think it's still in beta. I know it
Mhm.
comes up in YouTube itself, the ecosystem. It comes up as shorts, but yeah, they definitely have shorts. If you're using the beta portion of it, the labs
Mhm.
portion, then yeah, you'll see the shorts pop up in your Google
Okay.
search history.
I have
So this
a
could be very, very interesting. Go ahead.
I have a tech question. So,
Go ahead.
we're talking about AI all day and all night.
Mhm.
So how do companies or whoever
Mhm.
that have something, how do they make their product or their service like AI searchable?
Are you talking about like on like OpenAI's tools and stuff like
Yeah,
that?
because if everything is moving
It
towards
has to be made.
AI.
It has to be meta tagged in the sense that their
Mhm.
data is made available and not behind a wall. That makes it available to be accessed by those LLM models.
Okay.
That's the part. So if
'Cause
it's not, because what the LLMs do is they're cataloging the entire internet, and essentially
mhm.
like that's ultimately how the language models are being put together. But if you literally place it behind a wall, then they're not searchable to the LLM models, which means that essentially they won't have access to it.
Well, the reason why I'm bringing that up is because trend reports for 2025 are saying that now SEO, instead of it traditionally being known as search engine optimization, is going to be known now as search everywhere optimization.
That is
And that's
correct.
with the introduction of AI. So my question is, okay, well, how do you even go about making sure that your whatever you have is indexed for AI or
Well,
whatever?
the AI just does it on its own. So essentially, it's pulling in the data. It's pulling in the data from different sources, and then ultimately indexing it and placing it and categorizing it. And
Okay.
then when you start to search for it, then essentially now you get much more of a. Instead of you getting a bunch of search results, you get data, you get answers, and that's ultimately how it's comprised to where it indexes like an encyclopedia.
Very, very interesting.
Yeah. So moving on to Meta, watch for
Mhm.
user growth and revenue recovery. That's the biggest thing for them. I mean, of course,
Wait, say that again?
for Meta, which reports on the 30th,
Mhm.
watch out for user growth and revenue recovery. Those are the things to be on your radar. So has their revenues started to are they still in recovery? Because I think they had a good quarter last time. So that can they keep up that momentum and keep it going? I'm a little worried in the sense that I'm hearing that they're cutting 5% of they're cutting 5% of their workforce, which gives me a little reason for pause. But I mean, I'm not going to read into it too heavy right now, but it's something that's definitely on my mind. So if you're doing this cost cutting measure as it pertains to laying off 5% of your workforce, so I'm going to be looking at, okay, what has this and what areas were impacted in which that you were showing that you were weak, and I'm probably sure that those are the areas that got cut. It'll show itself in the earnings report.
Okay.
Amazon, watch out for e-commerce growth, and of course AWS performance in comparison to the other players like Azure, as we had just talked about. E-commerce growth. I mean, we already saw that consumer spending was up and they were on e-commerce platforms. So what does that look like as it pertains to Amazon's growth? And I'm going to add in a little caveat there. I would also look at Amazon's advertisement growth as well.
Ad growth, okay.
Because I think that honestly that they'll start leading towards ads, and that will also lead to content creators running also over to Amazon, especially the ones that talk about a lot of product related things. It's a perfect platform for them. Though that they need to improve the quality. They report on the 31st, to my knowledge. Of course, we got Apple. Of course, still going to be iPhone sales and services revenue. Those will be the things that reign supreme. You can look at the other things there, but I think that where investors are, they're looking for, well, what's new with Apple? And I don't think that Apple's going to give you that, but they're just going to still show you that they're a cash cow. And the question is really, I think out of those two things, because service revenue is just going to still keep growing. Like service revenue, like understand this, the amount of revenue that comes through service revenue beats a lot of S&P 500 companies' revenue.
Yeah, I know because I get an alert all the time. Apple taking money out my account.
It's not even just that. It's also the developers. It's also the App Store revenue. That's like there's a bunch comprised into that. But I would be really paying attention to those iPhone sales because a lot of folks are really talking about like, okay, hey, this whole China thing where they're not allowing government employees, and I'm like, does this really matter? I really want to know, like, is this going to be a misnomer again? Because we always find ourselves having the same type of narrative that's been going on for the past 4 years about Apple's revenues, and then next thing you know, they come in and blow it out of the park. So will this be the first time that it's actually right, or yet again wrong?
We'll see. We'll have to wait.
I'm expecting that to hear that on the 31st as well. And then of course we got Nvidia, which is always has to be like the ugly stepchild that doesn't fall in line with everybody else. They report all the way in February, late in February, which is estimated. So the things to watch out for them is AI chip demand and data center growth. Those are the things to definitely pay attention to. Now, this is significant. So I'm gonna go even further and like to prepare you guys as it pertains to the key themes to watch also. But here's the reason why it's significant to the market. So I made some notes here. So these companies, of course, as we know, they represent a significant portion of the S&P 500 market cap. So essentially, like if they get wiped out, then that literally destroys the entire thesis as it pertains to the S&P 500 going to like 7,000 or whatever you say, or S&P 500 going for a 3-peat 20% year. It's just not going to happen without those companies participating. So there's that. The other part is their performance is greatly influenced overall. It's partly due to overall market sentiment. So sentiment plays a role as it pertains to overall sentiment plays a role as it pertains to like how these companies perform, one, and then two, also where the market goes. These companies will dictate where the market goes. And a part of that is like also watching the bond yield. What we got: Microsoft, Alphabet, Meta, Amazon, Apple, Nvidia.
That's 6.
I mean, what else is there? Unless you want to throw in Broadcom or something like that, but honestly, like
no. But I thought it was the Mag 7, so I'm like,
I mean, you could throw in Tesla. Do we want to throw in Tesla as well?
I mean, yeah, if we're going to be watching earnings, yeah.
I mean, the numbers for Tesla is all about delivery. It's going to be the delivery numbers for sure. It's also going to be in the sense of like we're robo taxis, but really the numbers are going to be as it pertains to their guidance for the year, and which they probably won't. They'll probably just stick to their benchmark. But it's going to be about like what's the story that surrounds it, and how fast can they? What do they see this year? Will there be a product announcement this year? And I don't know if we'll get that in this earnings call. So it's all going to be data focused. Like this quarter is probably going to be all about fundamentals for every single company. Okay. Fundamentals versus the overall backdrop story. Does it match? And folks are like, hey, Mark, are you not doing it because Elon's being Elon? No, I'm just saying, like, honestly, it's I think we expect good things coming from Tesla this year. I mean, I think off of GP, I think that it's going to be one of those ones in which that it's their race to lose.
Okay,
it's their race to lose this year. Okay, so then the other part that's significant is earnings. Like, so the key things to watch. Let's look at that. So the AI integration, as I mentioned before. And then revenue. So how companies are monetizing these AI investments, and are they, and like I said, are they solidifying? So that's the number one thing to watch as it pertains to all AI or all companies that have been talking about AI. Does the revenue match up with what you've been saying? Are we seeing that? Are we seeing signs of that? If we're not seeing signs of that, that's a problem. Impact on profit margins and future growth projections. So like that's a key thing to watch. Like, is are the economics, is inflation, or is it having any type of impact on those things? And then on top of that, I'm watching the strong dollar, which could also have huge impacts as it pertains to currency exchange.
It's super strong right now.
So just be careful. Consumer spending trends. So we're looking at the economic health and potential, that will give us, as it pertains to economic health and recessionary risk. It will tell us geopolitical impacts. We want to know what the effects of global tensions on supply chains and international markets. What does that look like? And then finally, the regulatory environment. Like a lot of these companies will have a low bar as it pertains to regulation. Right. So under the new administration, how does that affect the tech sector? And I think that's the reason why you see everybody donating, what is it, like $1 million towards an event. Like, I mean, kiss the ring, and then ultimately, look, we give you this money, and then essentially, look, let us go do our thing. Let us go be, the best and brightest of the U.S.'s future, allegedly.
Heavy the allegedly.
So, okay. Those are the things that I would say that, everybody needs to pay attention to. Let's get to the Federal Reserve. It's because, they got some big decisions to make. And in my thought process, they're not going to make a decision. I think that they're going to just sit back and wait for the data. I think that they're going to let the data do its thing. And I think that they're also going to let the markets do part of its work for them. They're going to let everybody else get spooked. They're going to let they're going to let the market sentiment and market dynamics do its thing. And then essentially they're going to wait for the results of what the true data says. And then essentially they'll make their decision. But in the grand scheme of things, it's like, I think we will probably peak as it pertains to the 10-year treasury around 4.8, 4.9. I think that's the peak of the treasury. You may be able to get a 5%. You may be able to eke it out. But then at the same token, you're possibly screaming recession there also. So you have to walk a fine line as it pertains to what does that look like. And I think that for the Federal Reserve, people are saying that there's only two basis cuts, if that, this year. Look, I'm going to wait and see what the Fed says. I'm not going to fight the Fed. I'm just going to wait and see. If they say that they're data driven this year,
then they'll wait.
Let them be data driven.
So they make that decision, or make a decision January 28th. Or the 29th.
And I think that they're just going to leave it unchanged unless they see anything in the economic data that literally points otherwise. I think that they're ultimately just going to leave it as is. They're not going to do it. They're not going to go into a rate hike environment. They're not going to do 3 rate cuts or 4 rate cuts in the previous year and then come back the very next year and do a rate hike. That just doesn't make any sense. It could happen, but I just don't see that happening.
So they have inflation data. They have labor market data. So now they're just waiting on stuff that relates to this new administration and geopolitical.
Yeah. Because if tariffs hit the market, then essentially you have to readjust for that. If you're increasing your debt limit or increasing your debt ceiling and stuff like that, that's going to be things that you're going to have to readjust to. Everything that you see that's transpiring, that's happening government-wise and Treasury specific, is going to have an impact on the Fed. We saw this, over the previous years, where the Treasury was doing things, and then ultimately it influenced the Fed's decision, because of the fact is that you're expecting the Fed to do something, but when the Treasury does something, it's like, okay, well, I'm going to respond to you in kind. Okay. So yeah, that's where I see it playing out over this year. And honestly, I still believe that essentially that we're going to see growth. I think it's just going to be like, okay, hey, it's just going to be a little bit measured this year. And I don't know if we're going to get the same type of overall consensus sentiment I know that there's some folks out there in the camp that are saying, okay, hey, we'll wait till January 20th and then everything just like goes up and we'll see the pop. But I mean, it's possible, but at the same token, it's like you see a lot. I'm seeing a lot of investment. I'm seeing a lot of institutional money making a lot of the moves for the market right now. I don't really see a lot of retail movement that's transpiring right now. I see a lot of volumes that are like, for example, some of the quantum companies and some of these renewable energy companies. You're seeing a lot of activity that's happening on, the institutional side. That's not retail investors. So it's going to be interesting to see exactly how it plays over the next week. But it's beautiful because now we got earnings and financials are on deck with JP Morgan up at the bat first, alongside with Goldman Sachs and a few other players. So, watching them carefully.
We'll be tuned in.
Yes. So, and if you want us to go even further into the bag next week, so okay. So walk me through this. So this video has to get 750 likes in order for us to do. So this is for us to do the show and also for me to bring the guests next week.
Well,
because we just did this.
I think it's 750 likes
for the guest.
Well, yeah, but like also the guest is really good though, guys. It's really good.
Oh yeah. I mean, look, I give y'all. We try to bring y'all solid people that literally have a true pulse on what's happening within the market, and that
it's a good one, y'all.
Data. So
it's a good one. So 750 likes.
Okay. So if this video gets 750 likes, and honestly, look, if you're not subscribed,
I'm saying,
I mean,
what is up?
If you don't believe us, honestly, if you think that this is like a one-hit wonder video, like if you thought that this was a hit, I mean, for sure, give it a like. I mean, if it wasn't a W, I mean, that's okay. Just go ahead and write that in the comments. Be like, hey, this is what I would have done better. I'd love to hear your thought process. I know a lot of you guys want me to talk about like these individual stocks and everything else, but look, that's what Google's for. Like you can literally Google a lot of these companies. You can pull their earnings reports. And here's it, like I said, there's a cheat code. Now that you have a lot of thase LLMs that are out there and these companies are publicly traded, you can pull their earnings reports and then let the LLM literally break down the data for you. You can go through it will go through their guidance, it'll go through the reports, and then ultimately that's the beauty of what LLMs can do for you. Like you don't need, like in that regard, you don't need me to like literally do that for you. Like, because honestly, like you can go through at that point, you can go through like 50 different companies
in 2 seconds. If that,
I don't know if my upload speed as it pertains to me and the internet and indexing all that data is fast enough yet.
How's your signal strength, Mark?
My signal strength is 2 gigabits per second, but yet at the same token, look, that upload speed is a whole different story. But yeah, so all jokes aside, look, it's going to be an interesting way to navigate. We've been through a lot of choppiness since really December. And so I think that ultimately the market is really like following with what the bond market is telling it. And essentially until we start to see the bond market really start to settle down, then the markets are going to probably remain volatile. And going into earnings, I think that will ultimately give the bond market the narrative, or the market, the entire narrative of what it needs right now. There's just a lot of speculation as it pertains to what to expect, but now we're waiting to see what the data says.
All right, so we wait on the data.
We're going to have to wait on the data. We're going to be just like the Fed. We're going to be data driven in 2025. Right.
That's the best way to be, quite frankly.
I'm just saying, like, look, if we go for a three-peat, look, those end of 2020, you know what? Those end of 2026 targets.
Huh. Wait, what did I do?
So just pay attention. Oh, side note. And for those like, I got to leave you with an AMD comment.
Okay. So
your boy recently built a new machine. So that's Eleanor over there. I haven't given this one a name yet. I haven't given it a name yet.
Wait, why is that one named Eleanor?
Gone in 60 seconds. Like it was like one of the fastest machines that I've ever built.
Okay.
And so, and it's still dope, but I mean, you know,
well, the new one is pretty nice.
It is. I may take a photo so that way people can see it. Like, but I don't know if it's completely done yet, so we'll wait.
Knowing you, it has a couple more tweaks, but
it's like fine art; it's never complete. But interesting fact. So Intel's downfall is actually what's propelling AMD. So I would really look at, like, I'm really interested to see what those earnings look like. And the reason why I say this is because I got on my inner Dan Ives. And your boy was like literally trying to build his machine. Of course, he was in the market for buying an AMD Ryzen processor. Couldn't get an AMD Ryzen processor, the one that he wanted. And because it sold out everywhere. Everywhere. It sold out. I can get an Intel chip anywhere, but I can't get an AMD chip. And I happened to stumble across, I was like, yo, where are they? I just literally Googled, where are the AMD chips? And then an article posted saying, AMD says the reason why our chips are sold out is because Intel's chips suck right now.
Where are the shades? Oh, listen, my goodness.
Look, the shades are on break because it's winter. But yeah. So that was an interesting tidbit. So, and then they just recently did the whole CES thing. I'm gonna let sleeping dogs lie there, but. Yeah, so there's that.
Well, that was a big that.
Well, so y'all, thank you so much for watching today's show. I know that it was actually pretty refreshing to do another back-to-back, and then you know we may actually get a three-peat before the S&P 500 gives you one. So, but it depends upon you. It depends upon the market sentiment. Really does. So if sentiment says, "Hey, come back and bring something special," we will. I mean, we're still going to bring you value anyways, but I mean, again, it'd be nice.
But this one would be really, really good, y'all.
You know, yeah. So be sure to like, comment, and subscribe. If you're not subscribed yet, then go ahead and hit that subscribe button down below. And also make sure that you turn the notification bell on, because I know that some folks be missing in action, or they say that they're not seeing the videos. So we want to get a consensus of that one. So hit the bell. And when we go live next week, I want to make sure that you're actually seeing, like the show coming up. I want to make sure that, YouTube is not doing some shady stuff, like, shadow banning, your brother and sister, and then like it. So that way, if you like it, it'll probably go out to some other folks. So without each and every single one of you, we wouldn't be the Come Up series. So we thank you for watching. We thank you for giving us your insights. We thank you for giving us your comments. And on top of that, just your viewership. So until next time, I'm Mark Monroe.
And I'm Jillian GC in the place to be.
And this was your Come Up. We will see you next week.